When the export picked up in 2010, people realized that boxes were short, and so order keep on pouring in, and we have the momentum carry on from middle of 2010 all the way to now.
Right, but this is restocking, is that right?
Not restocking because as boxes get old, you have to get rid of them.
That's right.
So it is actually more to cover back the gap that created during the financial crisis when nobody built boxes.
Okay, so let me get this straight, because restocking to me sounds like people are getting rid of old containers and replacing it with new ones. They're not buying or adding to their stock, is that right?
Well, container demand is there when the trade flow is there. In fact, you know that there was a strong rebound of export in 2010, and even for this year, despite all the uncertainty, first half export of container cargo out of China increased by 11%.
That is stunning, isn't it? Considering we're talking about recession possibly here in Hong Kong, and anemic growth is not double dip elsewhere in the world.
Yes, but a lot of the goods are being carried are basic necessities. In fact, I think in some countries where economic slow down, people tend to turn more to budget stores, where cheap export from China actually meet the demand. So in fact, even with uncertainty, I believe that the 11% increase year on year will be maintained.
Oh, wow. Okay, so what about prices then? Because you expect container prices to average about 15% higher this year?
We managed to achieve a 60% increase in first half over last year.
60% in price?
16, 16.
16, okay.
Yes, last year average was 2004. We managed to get 2,276 for first half. Prices were softened a bit too, but we can maintain about 2,700 20-foot box.
Oh, really? Okay.
Yes.
And is this all about shipping, though? Because I know you're getting into railways as well. What about the demand from China?
In fact, the domestic demand is good.
Shipped on rail.
Our two big customers, one is China Railway, and one is Sinochem. China Railway, especially when more rail line built dedicated for passenger, so that the cargo train can pick up the speed. So a lot of old wagon cannot be used. So we are building containers for refrigerated container to carry foodstuff. We're building containers to carry liquid cargo.
Right.
So we expect a lot of demand for domestic use container for the railway. Not only normal container, but specialized container.
Specialized containers as well. What about cost for you? I know you basically get a lot of your profits in dollars, so you have a currency being impacted as well. The dollar weakness actually affecting you. Have you, hedge possibly for these currency moves?
One is our pricing is a cost plus basis. So we factor in the RMB appreciation. And we did a bond issue in Hong Kong in April this year, where we raised 13.6 billion renminbi of bond. So that is being used for our working capital in China.
Okay, so that's to help, I guess, offset the weaker dollar. What about costs? I have to ask you about costs, obviously, because wage inflation in China.
Our major cost actually is steel.
Steel? Yes,
steel. We use a type of steel called Corten steel, which is specialized steel, and that is quite stable. It has been going up from last year all the way to May this year, but so far it's stable. Our labor cost is about 4% of the total, so we already factor in the increase. Yes.
Yeah, okay, so it's more, I guess, raw materials. And you like your 11%, I guess, surge yesterday. Do you think the stock should be valued more?
More, because
of course, yes.
Yes. Like the rest, we came down quite a lot, the last few weeks. So I believe that we are earning. Our PE is still very low.